Finance Act 2023 is the fourth in a series of legislative amendments to be enacted by the federal government on an annual time frame. The passage of the Act reinforces FG's commitment to making incremental changes to Nigeria's fiscal framework that continues to be pivotal in achieving economic growth and sustainable development imperatives. Now, the changes introduced by the Act are intended to improve tax revenue, align changes in the prior Act to ensure tax equity and consistency, reform tax incentives regime for companies, and improve tax administration. The commencement date was revealed by His Excellency President Bola Ahmed Tinubu on 6th July 2023 to today. For an in-depth analysis and implications of these changes on tax administration, government agencies, and taxpayers operating across various sectors of the economy here, I have with me in the studio the managing consultant of Pedabo, Mr. Albert Folorenshaw. Thank you so much. It's good to have you in the studio.
Thank you, Tolu, for having me.
Yes.
Good afternoon, Nigeria.
Yes, it's good to be here again because 1st of September is finally here. Yeah. And understanding what this means, we have this act accompany the budget for some time now. So first, I'd like us to start with what really has been or has been the impact, if you were to assess since we started, and before we talk about the present one, talking about the impact on the entire finances of the state of the Nigerian economy.
Okay, thank you very much. You know, the first Finance Act in the recent series was the 2019 Finance Act.
Yes.
And then we have the 2020, 2021, 2022, and of course the latest one, 2023. And like you said, is majorly to support the implementation of the budget. Again, it is majorly to make sure that our tax laws are up to date, and it is an easy way of amending laws, and several of those laws have been amended, you know, in the series, I mean, from 2019. And that is what we have also seen has been done also in 2020. So it is not easy to take a wholesale amendment of some laws that have become, you know, obsolete. But of course, dealing with them in piecemeal, having to engage the National Assembly to amend those laws has become a bit easier through the Finance Act, instead of taking the whole tax law and attempting to update. And of course, you know, being tax law is something that has to be updated, has to be aligned with the realities and what is happening in the economy. And so that is what we have seen over the years.
Well, this set date of September 1st, which is today, what does it really mean for companies and businesses?
Okay, very good. For different type of taxes, a couple of changes were made, particularly to value-added tax. It was also made to company income tax and, of course, capital gains tax. Lucky enough, the FRS has been very proactive in this manner, and a recent circular of news was issued by the Federal Revenue to guide taxpayer as to how these provisions will be implemented in view of the deferment of the implementation. Again, talking about that deferment, it was good that the president did that so that taxpayers will get familiar with the provision of the law, and that was why he gave those 3 months for the implementation to commence today. And of course, businesses have carried out their transaction in 2022 up to now, and so they will not be impacted so much by the provision of this particular finance that is being implemented. For those that have been appointed, if you look at the provision of the 2023 Finance Act, some entities were appointed as agents of collection for VAT, which means apart from paying VAT on their revenue, they will also help government to withhold VAT on the invoices that are issued by their vendors. Okay, so that will take effect from 1st of September.
Yes.
So it has nothing to do with a prior period or anything. The same thing applies to VAT redefinition of building. Certain buildings in the telecom industry, particularly masts, and a couple of other items that were hitherto, you know, defined to be building, which has now been excluded. It then means that effective from 1st of September, okay, income accruing on those structures are now liable to VAT, and they are no longer classified as building or interest in building, which are not liable to VAT. Again, if you look at investment allowance, certain of those investment allowance has been removed from the law, which means companies are no longer eligible to claim investment allowance on their plant and equipment. It was thought to be rolling back on some tax expenditure in order to enhance tax revenue. And so the implication of that is that from the circular issued by the FRS is to the effect that only accounts, financial statements, that ended or that ends after 1st September 2023 will be impacted by that provision, which means you can still claim your investment allowance if you acquire asset prior to 1st September. Okay. Again, so which means again that if you are filing a return, if your accounting year ends maybe by 30th of September, this provision will become effective. 30th of November, and so on and so forth. So, but any account that has ended prior to 1st of September, for example, if the account ended 31st of August, okay, and you have acquisition of assets, you have acquisition of equipment that are eligible for investment allowance, you can still claim your investment allowance if the account ends 31st of March. But any account ending in subsequent month after 1st of September, that provision will no longer be available for such a company. Again, one significant one is the increase in the rate of tertiary education tax from 2.5% to 3%. That again will also be applicable for only accounting period ending after September 2023. Okay, accounting period ending after September 2023, before you start applying that 3% on the assessable profit of the company. And I think that clarification has been made by FRS. Okay. And I think given that time lag and the fact that it was not made retrospective, will definitely encourage taxpayers to comply.
All right, you already highlighted, because I was going there, that will highlight some basic notable facts in this document, but I think we can still talk more, because the digital assets and cryptocurrency thing that we also talked about the last time will now be liable to capital gains tax. Can we talk more about that, and what more do you think business people need to know about this document? Okay,
so if you look at the 2023 Finance Act, it touched on virtually all the tax laws. Starting with capital gains tax,
yes.
There are three specific provisions relating to capital gains tax, which is the one you just mentioned is the first one, the fact that cryptocurrency or any digital asset, if you dispose any digital asset and it is not your stock in trade, then of course capital gains tax will apply. Again, the second provision on capital gain is the fact that when you incur capital loss, the loss can now be set off against your capital gain, provided the gain is coming from the same type of asset that created the capital loss. That's the second one. The third one is the fact that rollover relief is now applicable to disposal of shares. In the 2021 Finance Act, the sale of shares which had hitherto been removed from chargeable gain was brought in. And the provision was that where you dispose of shares that is worth more than 100 million and is reinvested within the same year, CGT will not apply. But where you don't reinvest, capital gains tax will arise. Okay, but there's this lacuna around section 30 and 31 that has to do with rollover relief. Rollover relief is the relief that is granted where the proceeds of sale of an asset is reinvested in the acquisition of another asset of the same class. So which means if you reinvest in shares, you are eligible to claim rollover relief. But I'm sure that if the tax authority look at that provision again very well, you will see that the rollover relief impact under Section 31 is very limited. Then if you move to company income tax, the major one is the withdrawal of investment allowance and, of course, rural investment allowance. Investment allowance is just an additional, allowance that is granted on the acquisition of plant and equipment for any type of business. Okay, that has been rolled back by that provision, which means it's no longer claimable. And that's the one we're saying will not take effect from any account ending after 1st of September 2023. Of course, the rural investment allowance was also has also been cancelled. Not many people really enjoy that. Again, you have under Petroleum Profit Tax Act, you see that there was a redefinition or proper inclusion of the definition of decommissioning and abandonment, okay, which was well defined under the PIA. Yeah. Okay, so that has also been imported into the Petroleum Profit Tax Act, so that companies, in the same situation will be able to make similar provision. Again, a small amendment to the Stamp Duties Act, to the effect that the sharing formula, okay, will be 15% for federal government and FCT, 50% for state, and 35% for local government. That is supposed to take effect. That is purely administrative from the authority. I've also mentioned the provision relating to stamp duty, value-added tax. One significant one is the one that relates to the goods purchased from digital platform, operated by non-resident suppliers of goods. The provision is to the effect that when you buy any physical asset through those digital platforms, particularly a platform that is operated by an agent, by a company that the FRS has appointed as their agent for the purpose of VAT collection. What that provision is to the effect that when the goods arrived in Nigeria, it is, because the agent will have charged VAT and is expected to remit the VAT to FRS, even though they are non-resident, custom will not have the responsibility to charge VAT at the point of clearing the goods. Presently, when you are clearing goods, you pay custom duties and you pay VAT, which is collected by custom on behalf of FRS, and I think they account for it. But with this provision, custom should not charge VAT at the point of clearing such goods. What taxpayers would hope is that there has been that proper arrangement between custom and FRS to be sure that that provision is implemented, and it's very critical. And I also mentioned the issue around the TAT that has been increased to 3%. These are just a few of those
highlights. But in your assessment, of course, as a professional in this space, would you say the goals and objectives are being achieved with the Finance Act? Yes. Yeah.
Well, like I said, basically it's two objectives: it's revenue generation, and of course to make the tax law to be up to date and to align with international best practice. To a large extent, those objectives have been achieved. Of course, it is expected that education tax will go up. It is expected that VAT on assets acquired through the digital platform will now be accounted for by those agents because they are reputable firms that have been recognized. Again, under the provision, companies that have been appointed by FRS as their agent for VAT collection are now to file two returns. First is the one on the VAT they withhold, and then which should be done on the 14th of the following month, while the second one will be on their income, which will be filed on the 21st of the following month. Automatically, it means that FRS is able to zero down on where to collect their VAT, particularly on several vendors that deal with multinationals. So the multinationals, though, have been given extra work because they have to now file two returns for free because nobody pays for those collection services. Is a lot of burden for the taxpayer, but of course, it is expected that it will increase the revenue that is due to government because you have access to collect them from those appointed agents. So to a large extent, those objectives are being met.
Staying on that, or riding on that, government, of course, is trying to reduce borrowing. Even the minister just said that that could be last resort if that would ever happen. They're looking for ways to generate internally, and that brought up the presidential committee set up by the president to address fiscal and tax reforms. Now, what are your expectations of that committee? 18% tax to GDP, some would say it looks like a tall order. Nigeria's been around 6, around the last one we got is 10%. So 18 looks like, how achievable is this? How feasible is it?
Okay, so if you look at the tax revenue in Nigeria and you compare to those other countries where their tax to GDP rate is around 18, 20, 26, you will see that the Nigerian economy can definitely achieve much more than what those countries are reporting. Okay, so presently what we have is 10.86%.
Yes.
Okay, according to the recent analysis from FRS, and then we're talking about 18%. That should be a minimum. Okay, based on, if you focus on, it has to do with taxes collected by all the tiers of government, both the federal and the subnationals. And if you look at some other countries, even their personal income tax alone is more than the whole revenue collected by the 36 states in Nigeria and the federal government combined. And so the presidential committee, from what we have heard of the terms of reference, by the time they finish their work, we expect a lot of changes to be made, not only to the existing law, as well as into the process, the accounting for the revenue, the agencies that are obligated to account for the revenue. Okay, and I've heard the chairman also talk about the fact that they will expect that there will be one single authority in terms of accounting for the revenue. Okay, so a lot of leakages here and there.
Cost of collection.
By the time you even block those leakages alone, where local government people are blocking the roads, all of those are now being collected. There is harmonization in tax identification number for individuals and companies. Automatically, the revenue, definitely the 18% can be achieved. So we should be thinking about where is it going, because that is just a minimum.
Wow, that should just be a minimum.
That should be a minimum.
Wow. Well,
even without increasing any tax rate or anything.
Well, you already told Nigerians more that they need to know about this act and its prospects. So I would just say maybe like an entire outlook, maybe for the tax system. What is your outlook for our tax system moving on? Okay,
so from what I can see and what the presidential committee have set out from what we have seen in terms of the terms of reference, Nigeria is going to be more conversant with tax. There will be more focus on taxes. A lot of people don't take their taxes seriously now. People are going to be very particular as to what tax they pay, the fact that they want to be compliant, the fact that there will be enforcement, all of those are good. And of course, the ease of payment is going to be the one that will play the main role, because people, sometimes you really want to pay and then it's become so difficult for you to pay. Okay, so those are the things that we expect. And of course, the archaic laws are going to be reformed and amended to, address people's complaints and all the issues that a lot of people have complained around the existing provision of law. They are going to be written in understandable languages and things that one can relate to. And I've even heard that it may even be possible to have those laws in various dialects, which will make it much easier for people to comply.
Wow.
Okay, so we are all waiting for the committee to come up with with their work.
Interesting conversation there. I've been speaking to Mr. Albert Folorunsho. He's the managing consultant, Pedabo Professional Services, giving insights into the Finance Act and what should be expected. Thank you so much for your insights as usual. We appreciate your contributions.
Thank you very much.
All right, then.